Okay, hi, welcome. Thank you everyone for joining today. Again, our topic for this educational webcast is going to be deferred compensation plans. So we're going to get into that. Just a couple housekeeping items really quick. There are Q&A controls in your Zoom controls. So go ahead and submit any questions as we go or any questions you have coming in. We devote 10 minutes at the end of these presentations to some live Q&A. Go ahead and send them in throughout. If it makes sense to answer them on the spot, we'll do that. If not, we'll hit them in the 10 minutes at the end. So that's the main logistics here. So thanks again for joining, and let's get into this conversation today about deferred compensation plans. For anybody that's not joining us live, these are recorded and we're recording them on the Monday after Thanksgiving. So I hope everybody had a good Thanksgiving break. Hopefully, if you are still working, that you were able to devote some time to downtime, to rest, recharge, and to think about what you're thankful for. I know that something that was an interesting experiment this year, given that everything is going on, but it's kind of powerful to think about everything we have grateful for. So hopefully you had a good Thanksgiving break. And if you're watching this later, know that we recorded this the Monday after Thanksgiving. So today, again, deferred compensation plans, we want to spend time on really four main pieces of the deferred compensation puzzle. So first is really just the benefits. Why would you defer income? Why would you take your paycheck down the road when you can take it today? Talk about the risks of these plans. There are some benefits, but there's some risks as well to them. Talk about some individual factors that need to be considered as part of this decision to defer or not. And then for anyone that has money already deferred, important to think about some potential strategies to hedge your risk if you're concerned about the prospects for your company going forward, if you already have money in these plans. So that's our roadmap. And then again, we're going to allow some time at the end for some Q&A. So again, if you have any questions, go ahead and submit it now or as we go through the Q&A functionality in your Zoom controls. So first of all, just to set the table, a clever person said it's difficult to make predictions, especially about the future. This has been attributed to a few people, but it's funny at first, but it's exactly our predicament with a lot of things in life, with investing for sure, and with deferred compensation plans as well. Again, why would you willingly defer income today to only get it down the road 10, 15, 20 years, maybe down the road? And that's going to be tied to the prospects of your company. And so, why would you do that? Obviously, there's some benefits to that. And really in finance, certainly with this, it's about sort of weighing the odds and making the decision that sort of tilts the odds in our favor. So that's what we're trying to do. We can't necessarily predict the future, but we do want to make an educated decision that gives us the best odds for success in the future. So that's the name of the game. I think this framework that we're going to go through helps kind of put that into perspective and helps anybody make a informed decision around deferred compensation plans. So that first piece is why to do it. What are the benefits? Really, they're going to fall into a couple different buckets. So most of the benefits are going to be tax related, obviously. One of them is going to be tax rates. So this would be the ability to defer your income to a later period when your tax rate is lower, ideally. So this was a pretty big benefit, I would say, in the past, more so than today. So in the past, tax rates were higher and the spread between different tax rates were wider. So much more likely that you were going to be at a higher tax bracket today and then in retirement at a lower, sometimes significantly lower tax bracket. So that's kind of the tax rate arbitrage or element of these. Now, today, with tax rates being fairly low historically, and the difference, the graduation between the tax rates not being as significant, the chances are that you're going to be at a tax rate today while you're earning income, and then at a much lower rate when you're retirement is simply lower. So this first benefit, while it can come up, is, I would say, less of a benefit today than it was in the past. The one caveat to this, I would say, the tax rate piece of that puzzle is state income tax. So a lot of our clients live in Oregon, and just across the border, Washington State, there's no state income tax. And so you can have a situation where you're maybe even currently living in Washington, but working in Oregon and paying the Oregon tax as a result. In retirement, assuming you defer for at least a 10-year period, those distributions are going to be taxed at your state of residence. So there's two scenarios. One, you're already living in that state and you just maintain a residence there and you're in retirement, therefore avoid the income tax. The other would be a scenario where you move after you retire. And again, as long as you're deferring out for 10 years, that those distributions would be taxed at your state income tax rate. So that would be the one kind of caveat to that. At the federal level, there's usually not a big difference between maybe what you're earning in retirement, especially if you're like in RMDs where you're retired to take money out of your accounts. Might not be as big a difference there, but on the state level, you can. The tax deferral, though, is kind of the other piece of the benefits. And here, we're going to look at an example, but simply the fact that you can put money in before tax, that money can grow. Excuse me, that money can grow without taxes. And that the gains can compound without taxes is the big benefit. And we'll look at an example there. The other reason that you would do this is different companies offer matches. And so Intel, for example, has a match, or they did last year anyway, where any excess compensation above the limits there was matched by the company up to a certain amount as well. So there's some potential to get a company match through these plans. Each employer is going to differ how that's done, but point there is to understand how your company is going to do the match and contribute enough to get the match at least. It's sort of free money on top of anything you put in there. So just quickly, some examples. I mean, this is essentially tax brackets over time, the highest tax bracket, the lowest tax bracket. You can see how these brackets have become more compressed. So in the past, maybe there's a huge benefit to being able to defer income to get from a higher bracket to a lower bracket. Today, with the brackets more narrow, essentially, this has been less of a benefit. However, the tax deferral benefit remains. So the example here is $100,000 of income deferred for 10 years. What's the difference between doing it and not doing it? So we'll look at the tax deferred column and the taxable column. So make an assumption that it's taxed at the highest marginal tax rate, right around 40% to keep the numbers even. So just off the bat, if you're able to defer $100,000, it's not taxed and you can invest that whole amount, you're starting ahead, $100,000 versus $60,000 roughly of taxable funds to be invested after you pay the income tax on the amount. So you're starting ahead right off the bat. In addition, you can see here, anything growing pre-tax, and we're just simply using a Vanguard target date fund, the pre-tax and the after-tax returns for that fund, it's going to grow at a higher rate if you don't have to pay taxes. It makes sense. And so it turns into $230,000 over this 10-year period. Whereas at the lower growth rate and a lower starting amount only turns into $117,000. Now, the difference is the fully taxable amount. When that money is distributed, you're not going to owe taxes at that point. You're paying taxes along the way. Whereas in the tax deferred, you're going to have to pay taxes on that distribution. So even netting that out at the end ends up with about $22,000 more, a 22% benefit on that original $100,000. So this is the main benefit of deferred compensation plans. And as you can see, the further you go out, the bigger that benefit is. We looked at a 10-year scenario, but if you deferred it for 15, 20, 25 years, that benefit or the difference between the two, taxable and tax deferred, grows over time. So those are the big benefits. Obviously, there's going to be some risks. And the main risks of these plans are, again, we don't know the future, but you have to make decisions up front that have long-term ramifications. The biggest ramification is these are unsecured liabilities of your company. That means, one, it's going to be lower in the capital structure of the company. So you're a creditor of the company. It's going to be lower in the capital structure than somebody that's secured to the assets of the company. Equipment, plant, other assets of the company. You're gonna fall below those in the case of a bankruptcy or a bad situation. So that's the main risk of these plans. Additionally, the IRS has set this up where the company can't set a pool of money aside to fund this deferred compensation. It truly needs to be unsecured. There can't be a pool of money that's set up to fund these. So how would you assess that risk? I mean, that's the main risk. There's some benefits. How do you assess that risk? So there's really two ways as you're thinking about the risk of these plans as it relates to your company. You can look at that two ways. You can look at it on as if your company's an average company, or get more granular, more specific. So the average company example, you can kind of look at historically how many publicly traded companies have filed bankruptcy in any given year. And, it works out to about 2%. So in an average year, maybe 40, 50 companies file bankruptcy, publicly traded companies file bankruptcy. In a recessionary period, like we had in 2008 and 2009, it was something like 140 in 2008 and 210 or something like that in 2009. So if you take roughly assume 70 to 80 companies file bankruptcy in any given year, there's about 2,700 publicly traded companies, at least here in the US. If you do that math, it ends up about 2% of companies in any given year. So that would be kind of one way to do it, to assess the risk. Now, obviously, every company is going to be different. Apple's not the same thing as Sears or JCPenney's, for example. And so there you might want to look at some company specific factors. So back, I believe in the 60s, a professor at NYU, last name of Altman, developed this Z-score methodology where he would look at factors specific to the company that were on the balance sheet. So he could look at how much debt they had, for example, how much equity or retained earnings that they had, what was their market cap, what was their receivables and things like that. And he built this model to essentially predict bankruptcy in the near term. The model had three different score zones. So you had a safe zone, a gray zone, and a distress zone. So long story short, higher number, better number. You want to be above 3 to be in the safe zone. And if you're below 1.81, he called that the distress zone. And companies at that level had a much higher chance of filing bankruptcy in the near term. So that, if you're concerned about the prospects of your company going forward, that might be something to look at. So an example of what that looks like over time, I'll use Intel. So Intel is here in the purple line, and it's plotted against some of its competitors. And again, this is that Z-score number over time. So the competitors, AMD, NVIDIA, and IBM. And you can see here in the purple kind of Intel's history. So pretty high score in the 2000s. Obviously, Intel was booming. The whole tech sector was booming in the 2000s. And subsequently has been trending down over time. IBM's numbers been pretty flat over time. Intel, good news is it's above 3. It's still in that the safe zone, but again, trending down over time. So this would be one thing to sort of monitor. And we're going to talk about ways to potentially hedge the risk if you're concerned about that in the future. But this would be one thing to monitor. So, is your company safe now? Obviously, if you're deferring money for 10 years or something like that, this could change over time. So this could be one thing to monitor to assess that risk over time. So that's the second piece of the puzzle of assessing your company specific risk. There's benefits, there's risk. Here's a way to assess it. The third thing that we need to layer in here is individual factors. So this is kind of the go, no go decision. So you're comfortable with the benefits, you're comfortable with the risk. There's some individual criteria that you need to factor into, should I make this decision? Should I go ahead and defer money? So the first of those is really understanding what's your current exposure to your company. So here you would think about it as your income and any other investments, typically equity investments in your company that you have. You could also layer into that savings. What are your prospects to get another job? How long would that take if something were to happen to your company? It's essentially your existing exposure outside any deferred compensation risk that you'd be taking on to your company. Now, obviously, the lower exposure or the more comfortable you are, say if something were to happen to your company the more comfortable you are of like, yes, I can make a change. Yes, I can replace that income. The more risk you could be or should be or might be willing to take as it relates to deferred compensation plans. So that's the first thing here. The second individual criteria to consider is how much of your net worth is already in these deferred compensation plans. So again, the more money you've already deferred, the more money you have at risk with your company, the larger creditor you are to your company, the less willing you might be to put more money into the plans. So that'd be the second thing to look at, is just what percentage of your net worth is already in these deferred compensation plans. If it's your first time participating, obviously your risk of these is going to be lower than if you've been deferring money for years and you got $1 million in the plan or something like that. And then the last thing to consider here is how long you can or will defer that money. So here, if you're early in your career and you have the potential to, say, at the most extreme, defer it to retirement, you stay at that company the entire time, you could get a really long deferral. So say you're 20 years from retirement, say you choose a 10-year distribution, some of that money is going to be deferred for 30 years. So obviously that would be a very large potential benefit. If you're closer to retirement, say you're 1 year from retirement and you choose a 10-year distribution, the maximum amount of deferral there would be 11 years. So obviously the benefit in that scenario would be lower than the benefit in the scenario where you can defer it longer. So here, the thing to assess is the benefit going to be great enough to offset kind of the worry? If you're concerned about doing it and the benefit's going to be really small, maybe it doesn't make sense to do it. Now, obviously there's more individual factors that go along that. So for example, in the scenario we mentioned before about moving from state to state, the benefit gets bigger. It's not just about the deferral. If you have good reason to believe your tax rate's going to be significantly lower after you retire or stop working, that would be factored in as well. But holding some of the assumptions about a change in tax rate constant, really just the longer you defer, the bigger the benefit. And so if you can't defer for very long, that benefit's shorter, and that should be factored in as well. So that's the point there. So really 3 things to think about once you've kind of grappled with, yes, there's some benefits, some tax benefits. Yes, there's some risk. These would be the individual factors that you need to consider as well that are going to be specific to you, irrespective of your company's prospects going forward or not. So that's the third piece of the puzzle here, the individual factors. The last piece of this puzzle is really anything that can be done to offset the risks. Now, they make this a little bit difficult intentionally, the IRS, the way they've set this up. They set it up in such a way that you can't just go in and ask for your money back if you're concerned, right? You've got some significant skin in the game in order to avoid the taxes. And really, you're making an irrevocable decision up front to defer the money and get it back at some point in the future, whatever you picked when you defer the income. So whether that's 10 years down the road or a 10-year schedule or a 5-year schedule or something like that, you made the decision up front and you really can't change it. Some specific circumstances aside, you really can't change when you're getting that money back. If you can change it, typically it's changed, you can change it to defer it even longer, but you can't get it back earlier. So if you are concerned about the prospects of your company, say you're retired, you're close to being retired, you got a significant amount of money in these plans, what can you actually do? So there's really 3 strategies, short of just asking for your money back, 3 strategies that you can do to potentially offset some of this risk. So I want to walk through those, but in a big picture, it'd be, shift some of your risk, buy some protection, or participate in what's called a deferred compensation trust that we're going to look at here in a second. So the first strategy here, and again, remember this is as a reminder, this is our last section here. So if you do have any questions, go ahead and put them into the Q&A section, and then we'll get to those at the end. So again, our first strategy here would be to simply shift some of your risk by selling some of your equities. So remember, if you're participating in deferred compensation plans, you're a creditor of your company. The other way you could be tied to the prospects of your company is by owning equity in the company. So really 2 strategies here. If you're concerned about the prospects of your company, the most simple thing you could do is simply sell your equity in the company, sell your stock, and don't defer any compensation. So that'd be one thing. A more sort of complicated, maybe sophisticated way to do this would be to actually sell some of your equity, but defer some of your income. So this is kind of a way of hedging. You're reducing some risk on the equity side, but you're increasing the risk by deferring income and becoming a creditor of the company. Now, this is going to do a couple things, and we'll look at this in the scenario here. There's a lot of information on this slide, but this technique really does three things. So it can save you taxes in the current year. That's going to be done by changing the taxes you pay from income taxes to capital gains taxes. So you're able to sort of use that differential of tax treatment to save some taxes in the current year. You trade credit risk of your company for equity, or sorry, trade equity risk in your company for credit risk in the company. That would be the second thing. And the credit risk would be above in the capital structure of the company. The credit risk would be above the equity risk. So you should be able to, in most scenarios, the creditors are going to get paid out before the equity holders. And so you're increasing where you stay on the company capital structure. And then the third thing that allows you to do is actually sell that concentrated position. And then by moving money into the deferred compensation plan, invest in a potentially more diversified portfolio. So the quick example here is if you need $120,000 for living expenses, it's going to require a salary and bonus of roughly $200,000 after income taxes. You could generate that same $120,000 by selling roughly $160,000 in your company stock. So assuming no basis in the stock and taxed at the top capital gains tax rate, you only need that $160,000 of stock. So you're able to defer, say, 200 and sell 160, still fund the lifestyle and get these benefits that we've listed below. So that'd be one thing you could do if you're concerned about it. The other two scenarios are more hedge-like. So one of them, you could just simply buy puts. So puts are going to give you the right to sell a stock at a particular price. So this example was using Intel. So say, for example, you had $1 million of deferred compensation. Intel's price is around $47 a share. This is last week. You could go out there and buy on the market $50,000 or 50,000 puts of Intel that are out for 2 years, 2023, at a $25 strike price, meaning you can sell those shares of Intel for $25 at some point down the road. That's going to cost you $1.25 per put. So it costs you about $62,000. The scenario is if Intel falls to $5 a share or less, which you would assume they would in the case of a bankruptcy or some significant trouble where they couldn't pay out the deferred compensation plan, you're going to make a profit of $1 million on that position, right? You make the spread between the $25 that you can sell the shares for and the $5 price that it's at. So you make $1 million on that position, which basically offsets or hedges that $1 million of deferred compensation. So the problem with this really is twofold. One is the cost, right? That $62,000 represents about 6.25% of that $1 million, or about 3% a year. So it becomes pretty expensive to hedge it. The other problem with this is if you are still employed by your company, a lot of times there's going to be restrictions on, essentially, this would be going short your company. You benefit if the price of your company drops. So there's going to be restrictions for a lot of employees on doing this. This could work for you if you're retired, but if you're still employed, definitely check in to make sure that there's something that you can actually do. But that'd be one scenario, a little bit expensive, but it's something that can be done. The third scenario is something that's a little bit newer, here deferred compensation protection trust again is the name of this. The way this works is essentially pooling your risk among other people that have deferred compensation plans, but they're working for different companies, they're in different industries. So by pooling the risk, you can kind of help spread out your risk. Here, the idea is you put in a certain amount of money, about 1% a year, into this protection trust. 19 other people do so as well. And you're going to put in roughly 1% a year per year of protection. So if you wanted 5 years of protection, you'd put in 5%. If you wanted 10 years of protection, 10%. Other participants are going to do the same. At the end of that period, whatever it is, it's 5 years or 10 years, the assets in that trust are going to be paid out based on the number of bankruptcies. So if one company in the trust filed bankruptcy, the proceeds of that pool would go to that person whose company had filed bankruptcy over that period. If there's two, it'd be split. It'd be paid roughly 50-50 to both of those people whose firms had filed bankruptcy. So it essentially pools the risk. You are protecting some of that, some of the risk that you have in the plan by spreading it across multiple people. Again, this is 1% roughly per year versus the 3% we saw before by going straight to the options market. So could be a more attractive way to hedge that risk if it's something that you're concerned about. So that's it, really, deferred compensation. So there can be some benefits. There's obviously some risks, and there's some ways to assess that. There's some individual factors that you need to consider as well. And then if you are concerned about hedging that risk, there are some things that you can do. You can't ask for your money back, but there are some things you can do to potentially hedge some of that if that's something that you're concerned about or something that you want to do. So that's it. I'll pause here for a second for questions. I don't see any that have been submitted yet that we haven't answered, but give you a couple seconds if you do have any questions, if there's something I've missed, if there's something you want me to address. Go ahead and put it in. Otherwise, we will wrap up, and I will thank you for your participation and attendance today. Okay, it doesn't look like we've had any questions coming in now. Oh, looks like we're getting one now. Okay, so this is just a question about access to the slides. Yeah, we can make these available, so I'll get them out to you. Thank you for the question, Jason. I'll get that out to you. Looks like that's it. Again, thanks for attending. Hopefully this is helpful. If you do have ideas for anything else you want to see us cover in this format, go ahead and send them in, and we'd love to do that as well. So that's it. Thanks. I hope you have a good Monday afternoon. Bye.